Hello and welcome to Chapter 17. This particular chapter is about activity-based costing as opposed to traditional costing. The objective of activity-based costing is to get a more accurate product cost for products than what you would see in traditional costing. In traditional, what we're going to do is we're going to look at the differences between traditional and activity-based costing and why we need a new approach and what activity-based costing is. We're going to look at an example of how the differences between traditional and activity-based costing, and then we're going to look at the benefits and limitations of activity-based costing, and we're going to look at an example also in the service industry. Traditional costing, which was developed in the early 1900s, took manufacturing overhead costs and divided them by a single cost driver. And they would do that for both job order costing and process costing. Remember, job order costing, if you were to use, say, an automobile example, would be a company that repairs cars. Each car is going to look different as far as the repair. If there's an accident, let's say, then process costing might be a Ford Explorer assembly line where each vehicle looks the same with only subtle differences. And you notice job order costing, you might use direct labor costs, and machine hours might be used for process cost. The assumption here was that in both cases that there was sufficient enough to allocate the manufacturing overhead costs or the overhead costs for the facility to a product to give the cost a close enough number to be able to establish pricing and to determine whether you're making money or losing money on a product. But you needed a new approach. There was a huge change in the manufacturing and service companies from the early 1900s till the mid 80s when activity based costing came about. What really happened is we moved from a labor based society to a machine based society in production. And so we had a huge decrease in direct labor and a huge increase in overhead and machines and all the other stuff. And we had an increase in overhead cost. And we wanted to get more, the whole idea of activity based costing is we wanted to get more accurate about how we would allocate those costs, particularly the manufacturing overhead costs, to individual products. And there's not nearly as much of a correlation to individual products as there once was when traditional costing came about. And we use multiple allocation bases. And it's something called activity-based costing, which was first posited in the mid 1980s by Robin Cooper and Philip Kaplan from the Harvard University. Activity-based costing allocates overhead based off of multiple activity cost pools and assigns cost pools to products or services based off of cost drivers. Look at cost pools like dollars and look at cost drivers as units of some type. That's really what you're looking for. When we look at activity-based costing, and activity-based costing really, if I were to read this, you can read this, but what it really says is you're transforming raw materials into some type of finished goods. So you're starting off with, say, an ear of corn that was just picked, and you're going to transform that into a can of corn. That's going to be different activities. You might have an activity for that corn that's called receiving and prep. You might have cost pools, and you have cost pools are just groupings of activities. So we talked about receiving and prep and cost drivers. In our simple example, it might be if you're in receiving and prep, which is basically the corn coming in and they're in the receiving and prep, they're taking the skin off the outside and taking the corn off the cob. That's that's receiving and prep. And a cost driver might be the number of tons that have gone through the receiving and prep department. And what activity-based costing does is it allocates overhead costs into two stages. Overhead costs are allocated into cost pools, so in other words, buckets, and then those cost pools are assigned to activity cost pools into products, to individual products. And what this does is it makes the product cost more accurate than, say, what they would call in a traditional costing, where they only have one activity and they what they call peanut butter spread all the overhead to individual products, say that's pounds, and they actually determine what products should have higher cost based off of the resources that are consumed within their facility. So here's one example of activity-based costing. And you notice what happens here is you have different cost pools and different cost drivers. And we allocate those to the individual products that are produced. And what you're trying to do is get a more accurate cost of both the app bench and the app coaster. Here's another example, a little bit broader example. This is for a company called LiftJack. You have overhead costs and you have these cost pools. Remember, these are the sum of all these would be the total overhead cost. And and so these are all, if you will, most of these would be probably departments. And then these are going to be the drivers for these that they've determined in this particular company that they're going to use to allocate the individual products for that particular company. So what you do is in 4 steps, you identify and classify activities involved in the manufacture of specific products and allocate overhead to cost pools. So you're really, I don't like the word allocate here. I would say you assign overhead costs to cost pools. Then you figure out the cost driver, whatever it happens to be. One simple example, if you're looking at, say, human resources, the driver might be the number of applications received. And you're going to calculate a rate. So you're going to take the dollars here divided by the units, and you're going to come up with the overhead rate, and then you're going to assign them to individual products based off of the cost driver and the cost pool. So let's look at a simple example. Atlas Company produces 2 products, abdominal trainers, the ab bench and the ab coaster. And you can see the units here, 25,000 and 5,000. So there's a big difference between those two. And it says each product requires 1 hour of direct labor. So it says that they're going to need total direct labor hours of 30, and the direct labor cost is $12. So we know that you have $360,000 in direct labor. 12 times 30 is 360,000, and it says that it gives you the direct material cost, and it says we got to be able to, and we look at this overhead. So here it tells us what happens is required. Calculate the unit cost under ABC costing. Well, what happens? We're actually going to do this under traditional and then activity based. So you have one simple overhead rate, which would be traditional, is what we're looking at right now, and it's $30 per direct labor hour. You're going to take 900,000 divided by the 30,000 direct labor hours, and you're going to come up with $30 per direct labor hour, and you're going to assign both products $30 per direct labor hour. And that would tell you your total unit cost is $82 and $72. And you can look, here's the cost, $82 and $72. And this is traditional costing. Even though it has both on the header, this is traditional costing. One predetermined overhead rate for both. And you notice what it says. If you read this in the bottom, what it really says is if you use this, you can't really tell from here, but these numbers are used to establish pricing. And so based off of this, you're going to come up with a certain pricing level that you're going to sell each one of these products for. And you have to be very careful with that. And if you look at this, if we want to try and do the same thing for activity-based costing, it said now we took the 900,000, which was the total overhead, and we broke it down into 3 departments. And each of those departments is going to tell us what we're going to look at as far as, so these are the cost pools that they've established. And you have different total number of setups, machine hours, and inspections. So you're going to take these numbers and divide it by the dollars, and it's going to tell you the cost per setup, cost per machine hour, and cost per inspection. And so what we're going to do now is we're dissecting this further than just taking that peanut butter spread. Remember before we took 900,000 divided by 30,000 direct labor hours and assign it to individual products. Now what we're going to do is we're going to look at the setups for each individual product. We're going to look at the machine hours for each individual product. So the sum of these two, for example, this top one, the 1,500 is the two that we saw earlier, and we're adding them together now. But we want to know, we're going to take these to assign these to individual products. So we're going to take the rate that we had and multiply it times the number of units, the cost drivers, to assign cost to each one of the products. So if we look at, for example, the ab bench, we had 500 setup hours, machine setup, 30,000 machining hours, and 500 inspecting. So you have these totals, and it says that the overhead cost for the ab bench is 425,000 divided by 25,000 units. Says that your overhead cost is now going to be $17. If you remember, you had $30 before, and the total cost to make that is $95 for, and then the same thing is going to hold true for the ab coaster. You notice a humongous difference. Where before they were both 30, now the ab coaster gets a lot more money assigned to it based off of the activity rate, $65 more. So what happens? In one, if you look at the comparison, the difference is the ab bench was overstated by $13 and the ab coaster was understated by $65. Imagine if you're the salesperson, you're trying to quote a price. You would end up losing money if you try to quote price here. They would buy all they could because if your competitors were using activity based costing, then they would price their products differently. So if we look at activity based costing, what it does is it gives you a more accurate product cost. It enhances control overhead. I don't know if it really does that, but it allows for better management decisions because you price your product appropriately. But the next thing it does as well as well, one of the limitations is it's expensive to implement. It can be arbitrary with an arbitrary allocation. Because think about the simplicity of what you saw for traditional costing. All you had to do is take one number, divide it by one number, and come up with one rate. You already noticed that the level of complexity was much harder with just two products. Imagine if you produced 30,000 products in a particular facility. That means you'd have to mimic and understand how each one of those products flows through the facility and develop a model to cost those products. So when do you use it? The times that you should use activity-based costing is uh, is where you have differing volumes and differing manufacturing complexity. This is really called product diversity. This next one's product diversity, but you have different volumes and different complexities of the product. So if you have a really simple product or a really complex product, or you have one high volume, so when you set something up to run, it runs for a long time, or it's really complex. These two are going to drive higher or lower cost depending upon what you do. Diverse products, same kind of concept. These two are related. The products very different, even though they look the same in the bag or in the process, they might look completely different when you manufacture them. Think about, for example, a 10-speed bicycle or 15-speed or whatever versus a cruiser bicycle. Those are different types of bicycles. Uh, and if the overhead costs are a high percentage of total product cost, and if the manufacturing process has changed significantly, and the production and marketing managers, if they're ignoring the existing costing system. So you want to look at, and the next outcrop of this is something called activity-based management, and it's looking at value added versus non-value added activities. So what's a value added activity? Transforming a product. A non-value added activity might be a conveyor belt moving product from one location to another. So you want to try and eliminate non-value added activities and focus in on the value added activities. And if we look, here's some examples of um, value added versus non-value added. So it increases the perceived worth of the product. These are going to be value added activities. And these are going to be non-value added activities. Storage of inventory, moving inventory, which I just talked about. Building maintenance, inspection, inventory control. Some of these you want to talk about. There's something called do it right the first time. So you might not need inspections as much. Um, and for you guys that are going to be accounting majors, you'd probably be considered a non-value added activity. So they want to try and minimize what you do. Scary. So here's some classifications. We have unit level activities, batch level activities, product level activities, and facility. The allocations for these or the cost drivers are going to be different. And I'll just let you read through these so you can kind of get an idea of how you would do that for different levels of activity. But and if we go to a service company, the overall objective is to generate cost based off of the products. And as the overhead costs get higher, they're going to be allocated. It's hard to trace those costs back to by the company. So here's a simple example of traditional in the service industry. This is a CPA firm, and it says, okay, our predetermined overhead rate is the estimated overhead divided by the direct labor cost. So we're just coming up with a percent. It's 50%. And then what we're going to do is we're going to allocate to individual jobs based off of that 50%. So allocator applied. So we had $140,000 worth of direct labor. So we're going to have $70,000 worth of overhead that are applied to this particular job. And if you look, here's another one, but now we're doing an activity-based costing. You look at the number of partner hours, the revenue billed, and the direct professional. And you have different drivers and different costs. So what they're trying to do now is assign more costs to the ones that are more costly. So if we use this and we had the particular job that we just looked at, the costs allocated are $57,200 versus the 70,000. So under activity-based costing, this job looks much more profitable than it did under traditional. And so you're trying to make certain that a company gets the products costed correctly. and how they deliver the products um, separate. Now, if you want to take a look at this, this is kind of an interesting thing. It says that activity-based costing has only been adopted by like 50% of all companies. Part of that is because it's so expensive to implement and it's very difficult. And so depending upon the size of the company in particular and the competitiveness in the industry will determine whether or not they're going to adopt activity-based costing. So this is just an interesting study. That's it for chapter 17. I look forward to talking to you in chapter 18.